Hey, good morning. This is Jim Harvey and president of Opus 111 Group. I wanted to talk this week about, year-to-date economic and market performance, and also a topic that's coming up a lot these days, which has to do with, are we going to face a severe recession? The first thing I want to talk about is something that has been really unique in the last 5 years, which is this tremendous focus of the market, particularly the top 5 names in the S&P 500. And this is a great chart that shows you the difference between what the top 5 names were in 1999, which is over here. As you can see, Microsoft, GE, Cisco, Walmart, and Exxon. General Electric, Walmart, and Exxon being 3 value companies, and Microsoft and Cisco being 2 tech companies. And then you look at the 5 largest ones right now, and those are all tech companies: Apple, Microsoft, Google, Amazon, and Tesla. Microsoft being the only single one that is the same. And so when you look at these new names, they're massive. But the other thing that's really demonstrable about this is the concentration. Before the top 5s in 1999, which is this sort of orange line, the biggest percentage it represented of the entire market cap of the S&P was 17, and this has gotten as high as 24. It's right now around 22. I think that's very instructive, but it has an effect on the market, and I've been saying to my clients for a while now, you should trim your profits out of those large cap growth names because they're going to have in value. And in fact, that's happened. So if you look year-to-date performance, and this is through the end of October, Apple was down 22%, Microsoft was down 34%, Google was down 41%, Amazon was down 47%, and Tesla was down 47%. So the market has changed. We're now seeing such a concentration in growth, as has really been the case since the credit crisis. But part of the advantage those companies have enjoyed has to do with low cost of capital. All right, year to date, the market's been down. There's been continued increased volatility due to inflation, rising interest rates, Fed rate hikes, tax loss selling, and recessionary fears. And I thought it would be interesting to go through and take a look at the market data at different points. I actually updated this recently. So S&P through June was down 19, through September was down 22, now it's back down 17. The Dow Jones down 14, down 18 in the end of September, and now down only 8. NASDAQ down 28, down 29, and down 30. The NASDAQ names are also very highly correlated with those 5 companies that we just discussed. Russell 2000 down 22 in June, 24 in September, but only 19 now. But there have been some other developments like oil, treasuries, and gold, where oil was up quite a bit in June, and then only up slightly in September, and now down slightly. The 10-year treasury was up 9% in June, up 142% in September. And gold, which has always been a traditional thought on the part of especially gold bugs, that it's a great hedge of inflation, has done anything but. So that's by way of market drawdowns. Now, a lot of people worry when the market goes down. It's perfectly normal. However, if you go back to 1950, the market has been down every single year. On average, it's down about 13%. So this is not unusual. When we look at those numbers on the previous slide, and you see that the Dow is down 8 and the S&P is down 17. I mean, this is not an abnormal event, and yet it still feels abnormal every time we go through it. Here's another way to look at it. Here's the 1-year returns through September 30th. And as you can see, it's been a bloodbath, except in energy. Everything else is down, and ranging from down 11 to down 30 in small caps. So it's not just been the U.S., it's been worldwide. But just to blow this up a little bit, you can really see the numbers here. So again, there's 2 ways to look at it. Oh my gosh, the world's ending, or what's on sale, which is, of course, the way that we look at things. So here's another way of looking at it. Eaton Vance sends a wonderful thing out that we use every month. We don't have the one for November, that's through October 30th, but as you can see, the 1 year returns, large cap growth down 22, mid cap down 29, small cap down 29. But if you look out 3 years, it's a different story. So it raises the question, are we in fact going to go into a severe recession? Well, here's another one, and I don't know if anybody's been to the Big Island in Hawaii. I have, and I've seen this literally. It was going on years ago where the lava comes across the road. Guess what? You're not going through it. The National Bureau of Economic Research, NIBR, defines a recession as 2 consecutive quarters of declining GDP. And it occurs for lots of different reasons and different circumstances. For example, we look back in 2008, the reason why most people think that happened was excess debt in the housing market. I don't think that's exactly true. I think it had to do with leverage in derivatives, but they blamed it on the housing market. 2001, it was the asset bubble in technology stocks. Well, that kind of sounds a little bit familiar. And then shocks like COVID-19 pandemic can trigger recession-like symptoms. What happens typically during a recession? Well, unemployment rises, credit contracts, consumers reduce spending, which pressures economic growth. And in our country, 70% of our GDP is consumer driven. So if consumers reduce spending, then that's a problem. Corporate earnings will decline and stock prices along with them. So how severe is this recession? Well, first of all, let's look at some of those data based on what we just talked about. Unemployment is still less than 4%. It's 3.7% currently. There's about 10 million unoccupied jobs right now. So if you want a job, there's one out there for you, unless, of course, you don't have the training for it. Savings rate is still very high. Supply chain disruption is still not over. And why do I bring that up? Because, a lot of people say, oh my gosh, earnings are down, but part of that is because they haven't been able to fulfill those orders. So it's not like the orders are going away. They just haven't been, brought across the transom yet. So the fact that it's still not over tells us that revenue is still going to come. It's just going to come later than we wanted. Corporate earnings are still robust. Now, I do expect in the next year or two, corporate earnings to drop some, but not the year or two, sorry, next quarter or two, but it's still robust. So is this going to be a major recession? I don't think so. Well, here's to give it perspective. Going back to 1942 through 2022, this line is obviously the cumulative return of the S&P all the way up. And there are 12 recessions, since 1942. So there have been 12 recessions. And if every time the recession occurred, you said, oh my gosh, let's get out, you would miss a pretty significant move. So that's the point. Now, we're in a bear market, or we were certainly during the year when the market was down more than 20%, as I just showed you on the slides a couple of slides ago. The question is, does a bear market always result in recession? The answer is no. There are 4 major, recessions dating all the way back to 1940 to 42 that did not result in recessions. The other ones did. But the question is, all right, so you have a recession. What does that do to the expectations for S&P returns coming out of a recession? So here's a chart that talks about the recession drawdowns and then the price returns for subsequent years. And this goes all the way back to 1953. So you'll see here, the first one, the drawdown was 14%, and the subsequent 1, 3, and 5 year returns for the S&P. Down 20, down 13, down 36, down 48, etc. The worst was down 56, and that's not surprisingly the recession around the credit crisis. But if you look at this in more in closer focus, you'll see the average of all of these was down 30% as a drawdown, but the subsequent 1, 3, and 5 year total returns was up 43, up 64, and up 101%. Now that's not annualized, but who cares? If it's 5 years at 101%, that's 20% a year. So that's pretty darn good. Here's another thing to keep in mind. If we do have a recession, I think we're in one technically, and we certainly will be in one probably between now and mid-year next year. How long do they typically last? Well, the average is 13 months. The longest was 1929, which was 4 years. But as you can see, 13% isn't bad. If we took the 1929 thing out, the average would probably be around 8 months. So don't be scared, I guess is my point about recessions, because it's not a permanent situation. Here's another way of looking at recessions. This I found very interesting. Again, this is going back to 1948 and 49. Right before and during the recession, these are the negative returns of the S&P. And the 6 months before, we've had an average drop of 1%. And then during the recession, an average increase in the S&P of 3.8. And the first year after, there's only one negative year. That was in 2001, where the market was down 16%. In every other year, it was positive, and some of these numbers are pretty robust, 37, 36, 35, 45%. That was the COVID decline. And the average is up 21 for 1 year, up 49 for 3, and up 95 for 5, and over 10 years is up 257%. So I guess my bottom line here is, the next thing that we can worry about is runaway inflation. But quite frankly, are we going to have a severe recession? No. Are we going to have a recession? Yeah. And so with that in mind, we believe the thing to do is to look at your portfolio right now, see what kind of tax losses you might be able to get. Don't forget, with tax losses under current law, you get to carry those forward as long as you want, unless, of course, that law changes. And you can use use those losses against $3,000 of ordinary income every year and against future gains. Hope that's been interesting and useful. This is Jim Harvey, president of Opus 111 Group. I invite you to go to our website, and in particular to our Learn page, to hear more of these kinds of podcasts, my partner Mike's radio show, and written and audio other podcasts for your education. And hopefully it will make you feel better about your plan and will allow you to sleep more comfortably at night. Thanks. Have a good day.